All right, good afternoon, everyone. I want to thank you for taking some time out of your afternoon on a busy and holiday shortened week for the latest installment of the State of the FHA Secondary Market. This is, I believe, the fourth installment of this session. We started doing it right after really all hell broke loose in mid-March. A lot of disintermediation of the capital markets, certainly including government product, FHA. So our esteemed panel that I'll introduce here in a second, we asked this trio if they would help kind of lead a discussion with our members about what's going on with the FHA capital markets. And the topic remains pertinent, and we'll see what this group is seeing in terms of changes, developments with that part of our business. So our panelists, our first is the CEO of Altera Home Loans, the chairman of the Lender Board of Directors of the Mortgage Collaborative, and our first member ever, Jason Madiedo. Jason, thanks for joining us.
Thanks, Rich. Glad to be here.
And I'm loving the beard. The beard is great.
I'm gonna grow it all the way out.
Look like Duck Dynasty.
That's it.
Chief Lending Officer at PRMG, Kevin Peranio. Kevin, thank you.
Yeah, thanks for having me. I appreciate it.
and nice picture. So that's 300, right?
Yeah, how about that beard?
I like that beard. Yeah, I like Jason's better still, but it's impressive. Rob, you need
his is real. I agree.
Rob, you need a beard. You gotta.
Kevin, is it the clothing optional day at your household under quarantine? Is that why we're just seeing the regular photo like that?
Oh, every day's like that with all these little kids running around. Yeah, man. Toddlers, adults, parents, it's all good.
And then our friend Rob Kristen. Rob, thank you for joining us.
You bet.
All right, Jason, we've been starting with you. Your company originates a large percentage of government product and, really helped chronicle some of the things you were seeing in the secondary market in mid-March and over these last several weeks. What have you been seeing as of late?
Well, I'll start with saying that I think like April 1st, my beard was black. And through COVID, it's just gotten gray in the mortgage industry. So, I think what we're really seeing in this week has actually been, I think, really critical is the dust is settling and confidence is starting to work its way back in terms of pricing and options for non-Ginnie Mae issuers. I can tell you we have been a Ginnie Mae issuer, approved Ginnie Mae issuer for a while, but we never really delivered in a big way until COVID started. So we didn't have a lot of legacy loans in the pipeline or in servicing really much any at all. And all of our April and May, and now as we go into June deliveries, we're not seeing the sort of the big fear of as much forbearance as was expected. Now, I think that's a little bit insulated because it's much newer business. And so even though the job market's still not healthy, and I think we're still seeing some of that, continue to decline, it seems like relatively folks today that are getting home loans are, I don't know, maybe I don't want to be too optimistic, glass half full, but it seems like it's pretty safe. And I think that what aggregators are displaying, especially this week, has echoed that. So we had said when we first started this, Rich, that it was going to be about 60 days or so, maybe a little longer, 90 days before we saw some instance of the aggregation market coming back into wanting some gubby loans, and I think we're there this week. We're seeing AmeriHome being the leader of the pack in that regard. And is it okay to just sort of be
go to
team members, right?
Absolutely, yeah.
Family, just family. We're seeing AmeriHome really leading the pack in terms of the aggressor in government pricing, really in the 680 FICO and above, which is a little bit, if you're an issuer and you're seeing these prices go up, it does present a little bit of a challenge in the sense that you don't want to adversely select yourself by putting some of these loans in aggregation and then retaining all the lower FICO stuff. But AmeriHome Plaza seem to be leading the pack in our world, in the optics that we have to of anything in the government space around 680 and above. It still seems like after that 679 and below, it's still uncertain waters in terms of aggregation. But I would venture to say that over the next couple of weeks, especially with the report of mortgage applications for purchases starting to be on the rise, and again some of the dust settling, that we're seeing that aggregation market come back into the space, because once you have one start leading the pack, then everyone starts to seem to follow in that path. I think the question now is, if you're an issuer, what strategies do you apply? Because it starts to become a cash question and a risk question going forward. But looks very positive. Looks like people are getting back in the water. Maybe the Memorial Day weekend had something to do with it, and coming out of hibernation as states start to open. Anyway, that's my opening statement.
Excellent. Great overview, Jason, and good segue to Kevin Peranio from PRMG, who is an issuer, also both sides of the fence, buying FHA product, wholesale and correspondent, also their firm originating it on the retail side. Kevin, would welcome your perspective on the FHA secondary market.
Yeah, I actually, I really like that assessment from Jason. You know, we had definitely noticed AmeriHome coming back into it. And I remember on our last call, he and I were both mentioning that we thought some of the aggregators were starting to make a little bit of an appearance. And I think the way that our capital markets and strategy officer, one of the partners here at the company with me, Gary Malice, the way he said it is the bids were less offensive. And that was a couple of weeks ago. So we've been holding out. We still don't like the marks where they are. We mainly sell to PennyMac, AmeriHome, Wells Fargo. We do, when the bifurcated was out there, we were doing Chase and Wells, co-issuing. But we're actually very content continuing to service until the bids come in line with where we want. The margins aren't quite as fat as they were a month ago, and so it's starting to get a little more competitive out there. But again, to Jason's point, the bids under 640, 680, they're not quite there yet. The fear is, when you see all the forbearance numbers out there on government, ranging around 12%, which, if you guys recall, we had about 6,500 loans in our portfolio heading into this crisis. We were, a servicer. We've been a servicer for years, but we've always preferred to take our cash and just pick and choose our battles on servicing for prior years. But that legacy book is about 12% on the Ginnie, on forbearance. And so the worry is that loans that go into forbearance are now more likely to default. And so there is still that fear. There's a lot of modeling going on. Are we going to see 15%? Is it going to turn into 5% true default? So instead of a 2.5 or 3% default on your FHA loans, and literally dealing with foreclosures and workouts and all that kind of stuff, does it rise to 5? Does it rise to 6? Or true, like, not delinquency, default, like truly, like they're going into foreclosure, they're way past 90 days, game over. And so, those are the things that we're looking at, which of course the aggregators are also looking at, which is why we don't think the bids are there yet still. And so we're still servicing very heavily. And, to Jason's point again, we're on our new book. We've been very careful to make sure that, we're not making exceptions.
Thanks, Kevin. Rob, when our first version of this call, and everybody was freaking out and predicting the end of FHA lending, and you were kind of the calming voice of reason, saying that things would come around. They always come around. Sounds like they're starting to come around a little bit. Be interested in your perspective on what's going on right now at the FHA secondary markets.
Oh, I'm sorry. Did you lose me?
Oh. I think we did lose you. I think we lost you. I thought you were done. It had cut off right after you made a great point, and
Oh, it was like a mic drop, and I walked away. Yeah, I was still rambling. It's okay. I'll just shut up.
oh yeah, I'm sorry. It cut off perfectly though for whatever it's
Good.
worth. So.
Keep it rolling.
I was already into my Chrisman setting up next question to Rob. So Rob, take it from here, and we'll get back to Kevin.
Well, I don't want to steal any of Kevin's thunder, but and Rich, I appreciate you remembering that I was a calming influence and saying we would come back. Maybe I'm too old to get excited about much of anything these days. We've seen so much. The market is indeed coming back. I know Gateway First Bank came out lowering their FICOs yesterday, i.e. today. In fact, I had it in my commentary down to 640. And I think that with the new production that lenders are seeing out there, especially if they are putting in place, some kind of attestation letter about forbearance and having the borrower sign that and having the borrowers qualify for this new production, I mean, they pretty much have to have a job. They have to be able to have the ability to repay. And so the fear, especially with the new production, has ebbed out of the market to some extent. The aggregators are coming back. The initial forbearance estimates, I think, have been thankfully proven wrong. It's not as bad as many thought it was going to be. So that's nice to see. And it's backed by the government, and we've seen HUD and Ginnie Mae and so forth step up to the plate, and FHFA to some extent, although that's debatable, step up where things are needed. They've listened to the industry, and that's a good thing. They have not ignored, I think, a lot of the information that we were presenting to them in terms of forbearance, in terms of what if scenarios, and so all of these things have fallen into place. On top of that, we don't have the volatility. We don't have the interest rate volatility that we were seeing in March and April, early part of April. So that's calmed down. And when volatility calms down, I think everyone, not everyone, but a lot of people are less afraid of going back into the water, to coin a phrase. And so all of these things are helping. So the doomsday scenarios that were being bannered about in March have not come to fruition. The current origination with some of the safeguards that have been put in place seem to be working, and with the lower volatility, the aggregators are coming back in, and the servicing market to some extent is coming back. I think we've talked about on this call a couple times how looking back, I think companies who were able to add servicing in March and April and into early May are really adding a valuable asset, and perhaps are already looking back thinking, wow, we were able to add some of the servicing on our books at very low rates, low multiples, low prices. And I think it'll be interesting, not to talk too much about the future, although I know TMC likes to look toward the future, but it'll be interesting to see what happens when these companies, as we go through summer and into autumn and winter and so forth, if they start to maybe sell some of that servicing they've added at very low multiples, looking to pick up some gains on that. So it'll be interesting to see what happens to FHA servicing as the year goes on. So yeah, I think things are pretty good. The sun keeps coming up every day. People continue to need home loans. They want to get out of that 2-bedroom apartment into some place with a yard for the kids, because they're tired of putting up with them for 2 or 3 months now. So things are looking pretty good, I'd say.
Shaping up to be a really great year for mortgage lenders. Everybody was scared out of their minds in March between hedging gaffes and margin calls. A lot of our members had really great closing months in March, maybe didn't make money or lost money, but April and now May really super strong and shaping up like it's going to be a great year for the industry. So, Kevin, I want to go back to you around where you left off before you got cut off. Going back to something Rob talked about, the mindset of a servicer. You've mentioned that, been an issuer for a while and keeping your gunpowder dry and been selling the assets and the servicing to some of the big aggregators you mentioned. Just interested to go inside your mind, like the mindset by which, you retain that servicing or sell that servicing on FHA loans. Is it to some degree a bet like, right now the stock market's taken off, some states are starting to open up. It's obviously geographic, but there's some optimism right now that the economy could get back up and running quicker than we thought. Is that servicing decision almost a bet on how the economy recovers and employment?
Yeah, I would say yes, mostly that is the big driver. But I think the Fed is the driver here. And I think, I think we'd be remiss if we didn't kind of recount some of the steps. I don't want to rehash all the history, but the reason why there was doomsday and doomsayers in March is because the way policies are written they're not set up to handle what we went through. And so the Fed had to make an unprecedented cut on a Sunday to a 0% interest rate before their meeting, which bombed everyone out and gave everyone, tons of locks and low rates, but then forced the margin calls. So then people like Barry Habib had to go get Steve Leishman on CNBC to put out bad press and say, the Fed, you're a bunch of idiots. You came out too hot and heavy. So they backed off and stabilized that. And then, they basically had another, Monday morning, Sunday late decision at the Fed to say, we're going to buy unlimited amounts. And then, so they really stabilized the market. I mean, they're the biggest buyer by far. I mean, we have, the Fed didn't take their action, we would be dead in the water. This industry would have come to a grinding halt with no liquidity. So then the CARES Act passes. And every servicer has to front money. You have to front money for borrowers who miss payments for 12 months, plus, tax and insurance, which, by the way, we can't roll the tax and insurance even to this day into the deferral payment option. So, unless they're due, unless it's November, and a borrower has stretched all the way to that far, every servicer is putting up. We're putting up billions of dollars to pay for tax and insurance. So we're not out of the water as far as liquidity goes. Don't forget, the FHFA said, hey, you know what? You only have to make 4 payments. We'll make payments 5 through 12. That brought stability and liquidity. Ginnie Mae came out and said, if you need to borrow money, through, our pass-through assistance program, we got you. It's going to be a 6% rate or a 5.7% rate or whatever it is, but we have money for you. So let's not forget all these crazy, unprecedented actions had to be made to get to the point where we consider and go, hey, yeah, you know what? We knew we'd get past this. So it's crazy, to think that like we're building this airplane as we're flying it. But that's the mortgage business. I mean, we don't let our borrowers and realtors see all the sausage making that goes on behind the scenes either. So, so, I don't know if that really answers your question other than, there's still a lot left to do. There's still a lot of money to front. There are losses that are coming, and it's up to the services to pay for it. Having said all that, we still love where this market's at, and we think it can only get better from here, assuming we don't have like a re-shutdown. We're going to get a spike in the fall. We're going to get a spike of coronavirus cases in the fall. It's going to be colder. Every single pandemic that's ever hit this country if you look at every single curve, there's always been a smaller curve, but there's a spike later. So here in California, Rob and I were so blessed that our governor, he will likely shut everything down all over again, to make it look like he's super responsible and set himself up for a presidential bid in 2024. But not every state will do that. And so everyone's going to have to deal with different policies. We have a huge presence in Florida. I mean, they're in phase 1 of 4, how to reopen the economy, but they didn't say they didn't give us steps on how to open our business. So servicing is getting better. There's 38.6 million people that have made jobless claims, continuing unemployment at 25 million. But those are mostly people $30,000 a year jobs and under. They're not really homeowners. But, how do we reopen our businesses? How do we get back? I want to do more than just cookie cutter refis. I want to open back up all the down payment assistance programs without fear of, US Bank or, whoever the master servicer is saying, hey, I'm going to kick this back if they ask for forbearance. So there's still a lot left undone.
Thanks, Kevin. Great insight. Jason, your firm originates a lot of government product. I just got, that's fresh in my mind. I just got done writing the executive summary for TMC Benchmark, the April data. I just posted it to LinkedIn. Some interesting things, record closings for at least the 3 years we've been tracking numbers on Benchmark, record efficiency, like off the chart efficiency in April, with everybody sending their staffs remote on no notice. One other interesting thing, the percentage of closed loan units that were government, 18%, which is by far the lowest number we've ever seen. Typically, that number resides somewhere in the 30s for our members. So interested how at your firm, the production mix has been affected. And then also, you've, over the course of these calls, chronicled your strategy as it related to different FICO bands, where you were being more aggressive, where you were seeing better bids. So I'd be interested to know how your production mix has changed and how maybe your strategy on FICO bands has changed.
Yeah, so we have for the last, since inception, so 12 years, we have been 85% purchase, almost like clockwork. And, few percentage points up and down here and there, but even through some of the other refinance, periods, we were still very high purchase, stayed very laser focused. This time around, it was very different for us. Our sales group really pivoted, and over the last 60 days, we have been about 52% refi. So never really done that. And we've had a lot of our salespeople that have been with us for a long time. So it was interesting for us in terms of mix, because it really did push some of our government volume downward, even though we did do a healthy handful of some FHA streamlined refi and a little bit of VA roll. We don't play a whole lot in that VA space, but we did pivot into refi a lot more than we ever have, which is what I think for us is the most interesting part, is that we have learned to use a muscle at our company that we have not traditionally used at all. I mean, it was like legs on a boxer. There was no purpose other than to stand up. And so now, I think we've done a lot of squats, and we're much stronger in that area. And it's something that we're not going to forget, not something that we're going to let go. I know that our group is going to tend to lean towards purchase, because it is something that is in our culture, in our fabric of who we are. But that's one way that we pivoted. And it changed for us in terms of product mix, a lot more refi. And I think that as we're seeing purchase come up, for us, we're going to work towards grabbing that purchase. It's where we're most comfortable, but we're not going to let go of the refi anymore. I think that's just going to be part of our company and our loan officers now. I think on the FICO band question, what was pricing differential between a 680 and a 720 up? A 680 is now behaving like a 720 in I think the pricing world. There is really not much difference. And you're seeing that the same thing happen in the aggregator world. So we're kind of monitoring that and trying to follow and stay either in lockstep or a little ahead of that. When you get into the lower FICO range, I think that's where the Ginnie issuers become more competitive, and where we've had a lot of discussion around that in terms of what are the spreads. We're seeing that compress as well. So I think where there was probably 100 basis point differential, or I'm sorry, a 200 basis point differential between a 680 down to a 660, that gap is now 100 basis points or less. And we're seeing ourselves have to follow. I think where you were seeing 640 be the floor in some of the issuers, and not the aggregators so much. I think more in the issuers that have big retail presence, where 640 was the floor, and you really couldn't price anything under 640. I think 620 is now the new 640. 620s are pricing right around where 640s are. So you can see that sort of pressure changing in terms of where we are pricing and where I think others are pricing. So 620 is now basically pricing like 640. We don't see a whole lot of people underneath that. There are a few. I know one Carrington that is still playing in that 500 space. And then 680 is really now, from a pricing perspective, that we see the new 720. And in the middle, it's just sort of gapped in between. But the 400 and 350 basis point margins that I think we were seeing in April and even in March are pretty much gone. I think from that perspective, in that middle FICO range.
Thanks, Jason. And goes without saying on these calls, but any questions, comments of anyone has, obviously feel free to leave them in the chat or the Q&A, and we can voice them aloud. We got about 15, 20 minutes left. I turn to Rob. The money center banks, it seems like, after the 07, 08 meltdown, they ran away from government lending like it was a live grenade. It seems now like they're back in the mix a little bit, not fully to where they were pre-pandemic, but feels like they are treading with more confidence in the Govy waters, just a couple months out from, when things started to change. So any thoughts on the money center bank strategy these last couple months, Rob, and how you might see it evolve going forward?
Yeah, the Chase, Wells, Citi, B of A on the retail side, Chase on the retail side. It's been interesting watching when last autumn, when the Department of Justice and HUD came out with the letter saying, clarifying some of their positions on things. And then, there was a lot of talk about Chase getting back in, Wells Fargo getting back in on the correspondent side. Not that Wells officially exited buying FHA loans, but the origination side. And Jamie Dimon has never hidden the fact that he's not a huge fan of residential lending in general. And then when you get into FHA and the ability for the government to assess treble damages, can be a real stumbling block, and it has been. I think that cleared up some things. And then with regard to what we've seen in March and April, the money center banks, you have to remember the money center banks have a different mentality than the quick and nimble independent mortgage banks, the non-depository mortgage banks. The money center banks have so many other avenues of revenue, whether it's Fannie Freddie, whether it's car loans, whether it's trust business, whether it's credit cards, so forth and so on. So the residential lending is just a piece of the pie. And the question is, how much risk do they want that piece of the pie to assume, given the potential reward for that piece of the pie? And the dynamics, the algorithms that the pricing goes through in order to determine that, if you're a big money center bank, I mean, you've got teams of actuarials and statisticians working on it. You have typically large servicing portfolios in the case of Wells or Chase, looking at every item of performance for their for the servicing, and where they're losing money, where they're making money, and so forth, and what is the advantage of having a client. So the question is, what kind of client do they want to add through that FHA VA channel? Is that a client they want? Maybe yes, maybe no. What are the chances of that client refinancing, so forth? What other attributes does that client bring to the book of business of a money center bank? So you have huge staffs and huge, I don't know if they have supercomputers anymore, but a lot of focus is being put on residential lending. And so the moves that they make are very calculated. It's just not like, oh, yeah, Joe in the Modesto branch needs an eighth or needs a quarter to get the deal. Sure, go ahead. Joe's a good guy. It's not that kind of mindset when you're a money center bank. It is very, very calculated. And so the moves that we've seen in terms of money center banks coming back into the market in certain geographic areas, certain products, certain price points are very calculated. I would expect going through 2020, given the decline in volatility that we've seen, both with product guidelines and with pricing and with the MBS market, I would see money center banks continuing to get back into the business and increase their scope. Just what I sense is happening out there and what will happen. So that's what I think is going to happen, Rich, for the remainder of the year.
Thanks, Rob.
Kevin,
oh yeah, Jason, go ahead.
wanted to echo Rob's statement, comments, because I think it's just spot on. It's a little bit of someone stuck the ladle in the soup and just spun it around a little bit, but it's what we're seeing. It's pretty traditional that the independent mortgage banks, big aggregators that are non-banked, are leading the pack in terms of getting back out there and wanting to win some of that business. But where money center banks were 200 basis points off of whoever the pack leader was a month or two ago, that is now 100 basis point spread. And I think, as Rob said, as time continues and they're very methodical, they'll work their way back in. But what we're seeing is any of the best money center bank type is about 100 basis points off of the best independent mortgage bank or big aggregator that's non-bank, and they seem to be leading the pack in that. But it's not too far. It could be a week or two, and then all of a sudden you see them 50 basis points off, and then right in line, and now everybody's competing, heavily for that business.
Great insight, Jason. Kevin, all our members, like after all hell started breaking loose, trying to get their predictions on where the Ginnie Mae forbearance percentage would end up at. I want to say it was 15-16% was their feeling. I think we're at about 12% right now. It still could go up a little bit, obviously, but I know the biggest fear of our independent mortgage banker members, particularly, as all that was happening, was just the buyback risk that they felt was evolving, selling loans to the aggregators that could go into forbearance, after delivery, before funding, or even after funding, and get put back on them. It seems like those fears have not been as bad as they thought. What has been your experience on kind of the post-sale side of the business?
So we just stopped selling to everybody and just serviced 100%. So we just weren't going to take the risk, and so we haven't dealt with that. So I actually I haven't heard of anyone having loans put back on them. I've read some articles that repurchases are on the rise, or potentially. So I don't know exactly how that's going to play out. Let's not forget, at least on the Fannie Freddie side, Director Calabria, they basically came out and said, look, you can have missed one payment now, and they'll buy that loan, either with a 500 or 700 basis point hit, but no cash out. On FHA loans, it's still actually unclear. They haven't really come out with a policy that said, look, if a loan's in forbearance, are they going to insure it? I mean, that's still kind of being worked out. That hasn't been stated. So we sell into the cash window with the GSEs. So we're selling these loans so quick.
I apologize. Hope
You can hear me.
Kevin, is the Bluetooth and the Bentley acting up? What's going on over there?
Yeah. It's like you just can't get anything right. I'm not on Wi-Fi because my Wi-Fi sucks. I go out in the car so the kids can't hear me, and then somebody calls even though I have my phone on Do Not Disturb. What are you gonna do? So, I'll say that selling in the cash window has been our saving grace, and so we're not dealing with the aggregators from that respect. A few weeks ago, I think I mentioned in our last call, we're going down to 580. So we're selling to 580 FICO internally for retail. We're at 640 minimum FICO on government lending in our wholesale and correspondent channels. This liquidity crisis affected everybody. So on the wholesale side, UWM's the biggest lender out there. They really constricted what they're buying, and they're not endlessly buying either. So we were getting flooded with a ton of their overflow on the wholesale channel, which we didn't want them to drown out our retail channel. So we actually raised our margins in wholesale and correspondent, and our retail pricing is smoking, especially on VA. So for us, that was a move that we made. We are still 60% purchase in retail year to date. We are 49% purchase in our wholesale channel and 38% purchase in correspondent. So, as those models continues to get better and better in pricing, with more risk being taken by, the wholesale broker or the correspondent lender, they get better pricing. And so refi tends to move in those channels directions just naturally. But yeah, we've got, we're seeing things open up and thaw out, but it's because we're servicing 100% and just trying to control our own destiny.
Kevin, I asked you this question a month or so ago on this call. The mortgage broker slice of the pie, between 12 and 20%, depending on who you ask and whose numbers you look at. What do you feel? Do you feel like what's been going on in the last few months, if it will either positively or negatively impact mortgage broker market share as we move into the summer and fall in 2021?
So the big driver for broker market share has been United Wholesale Mortgage. They, in my opinion, have built the best mousetrap, and they also were making concerted effort to convert retail lenders, originators to broker. And so, we're of the mindset where, look, we have all three channels, so we'll serve we say built by originators for originators. It's because we're trying to serve them no matter where they want to go. They're different. They're just different. If you don't want to work for another human being, then go start your own company, and there's a TPO channel for you. If you feel like you can scale and have a better strength in numbers approach, or you really like the leadership, whether you're direct line or all the way to the top, then you'll find a great home at a retail mortgage banker. So we don't really judge which one's better or not. So having said that, pricing is better in wholesale. It's just better in wholesale, and that number is non-doc core, by the way, is even better than that. Generally, these are just generalizations. So their market share has stalled out a little bit under 20%. Now that's also with Quicken, however, reporting everything as quote unquote retail, which they're one of the larger wholesale lenders out there. They don't report their broker business as TPO.
Really?
So that market, yeah, they don't. They record everything as retail, and they call everyone our partner network. So whether it's the little monkey on a headset in Detroit, or it's a broker that sends them a loan, they call it, it's all, they classify all of that business as retail, and so the share is probably a little higher. And if you think about it, when we all sell our loans to PennyMac or AmeriHome, they count that volume too in the overall 2.2 or 2.4 trillion. So it's like some of the volume, most of the volume is double counted. Mm-hmm. So so that market share is probably 25 to 27%. Now, again, in a refi market, which we're going to have low rates for the foreseeable future with $5 trillion in refinances available, right now with current market rates, I think their share is going to grow. But, I love what Jason said about the purchase business. Don't sleep on that. We've all built up our companies. I don't think there's too many wholesale lenders on this call, but we've all built up our retail presences in the communities based on purchase business, getting deeply rooted in the community, building those bonds with referral networks and partners. And that is bearing fruit right now, even though there's less housing supply. There's still a tremendous amount of purchase business. I mean, we're going to do 4 to 4.3 million units this year. It's a normal purchase market. So there'll be $1 trillion in purchase money in the business this year. That's a lot for us to go out and get. And so that I still feel like it's kind of like a tale of two business models. And so, yeah, that will grow, and that's evolving and competing for those refi dollars. But I mean, that's a race to the bottom over there. Before COVID-19, everyone's talking about fintech disruption. Well, I mean, the way to fight fintech disruption is to showcase local and show how local wins business, and being local and doing the purchase business and doing the tough deals and the first time home buyer loans that have hair in addition to the cookie cutter ones. I think that, that is where all of our TMC members, where we shine. And so there's still, I would double emphasize, 10x emphasize our marketing and our efforts on the purchase business, because that stuff's not going to go away. I wouldn't give that foothold up to any channel or any competitor, no matter who it is.
Good stuff, Kevin. Jason, before we go to Rob for some final words of wisdom, we had a question come in. That's a good one. Will Ginny also make an announcement clarifying the forbearance issue for FHA borrowers who want to refinance or purchase in the future, much like the FHA announced recently regarding getting current or making 3 consecutive payments on Fannie Freddie loans? What have you heard, if anything, there?
Yeah, first of all, Kevin, pretty badass white leather there, and very brave with kids having white leather. So it shows that
they're not allowed in here, just for the record. They cannot come in this car.
You're definitely in the mortgage industry. You got white leather and little ones.
Let's go.
Risk taker. So, I think that organizations and trade organizations need to continue to put pressure on FHA to put out something. I think Kevin alluded to it, that FHFA has given some clear guidance on, or clearer, I should say, guidance on what to do with borrowers in forbearance that either want to get a mortgage or want to refinance and take advantage of low rates. And they've put these groups into categories, whether you are completely in forbearance and you need to get 3 payments back, or even to the point, which we talked about in one of our last meetings, when they have on their credit report, it says something about forbearance, but they've never made, never not made a mortgage payment. So there's clarity there. And FHA has not came out yet and clarified it, which makes it more difficult. We need to put some more pressure on FHA to just, give a little bit more clarity. I'm still hopeful, and I think Kevin coined this, the CARP refi program.
CARP,
and it's still not there yet. I mean, hopefully that someone's thinking about it in the works, because I agree. I think we need to figure out how many of these forbearance loans are really actually going to go into foreclosure. People have equity today, and so they're going to think about their homes a little different than they did back in 2008 and 9.
Jason, I was going to say, I was just on a call this morning with the Mortgage Bankers Association. It was an executive call, and Pete Mills, who's been lobbying on all of our behalf, like just an absolute beast, he said that Ginnie Mae is very close to providing guidance on this topic. And so I actually asked that question. In fact, Rob sent me an email this morning, about this particular, Ginnie Mae and FHA and the deferred payment option. And, they were first to come out and give a liquidity lifeline, whereas FHFA never did that because they want all of us to just wither away and die or get recapitalized. But they were, like you said, more clear on that policy regarding loans. And now borrowers are eligible for refinance on Fannie or Freddie as long as they pay all and reinstate, or they make 3 payments on their loss mitigation plan. FHA, USDA, VA have not had that clear guidance yet. But I was told literally just this morning that it is coming soon. They're very close.
Well, that's great to hear. And I think as soon as that comes out, I think we're going to see a very, very different picture in terms of aggregator pricing, and even some of the big banks in terms of pricing and how aggressive that might look. Hopefully it's short, but I'll just last words on my part, Rich, turn it over to Rob, is just from what I'm listening and hearing. I think home ownership desire is like never before. Anyone who spent the last 2 months locked in a 1-bedroom apartment that's 600 square feet is going, God damn it, I really want to own my own home now. And I got to figure out how to do that. And everyone on this call, all the members, everyone, that's our job. That's what we have to do. I think Kevin's right. We need to stay focused on why a lot of us are here, and that is homeownership and helping first-time home buyers do that. Inventory, is still going to be an issue, but it was an issue before. So, we got to deal with it. I think that the rest, for all the members as well as us, and hopefully you are having these issues, and for good reason, is that I think we miscalculated what capacities we needed to be at. Some of us did, I know we did, a little concerned about where volumes were going, and it's really great. I think the market is going to be great. We're still going to hit some bumps. The scratch and dent market isn't really there. There's some inkling, and you're seeing some people come back, but the bids are weak and it's not really that great. So the credit quality has to be good, and we can't really have too many material defects, but that will come back too. And so I think we need to be ready for capacity, low rates, people are hungry. And, as soon as the job market starts working its way back, which is I believe the driver for our industry. So that's my 2 cents.
Some great points there. We're going to start doing a somewhat recurring call on the scratch and dent market, just as that evolves, somewhat similar to this, with some people we're lining up. And a great point you made that I have not heard made yet, that what is going on right now really emboldening the value of your home. That person that has spent the last 2.5 months in a small apartment. Also, the savings rate is at an all-time high right now in America. So those are things that could bode really well for the purchase market. In addition to, obviously, the interest rate climate. Kevin mentioned we could do $1 trillion in purchase business this year. It's looking like the industry could do $2.5 trillion this year, which would be a historically really great year for the mortgage industry. So good stuff. Rob, a lot of great discussion here today, and I'm leaving it to you to take us away with some words of wisdom.
I shouldn't have sent Jason my closing speech because now I have nothing left to say.
Oh, that was good. Yeah.
I'll echo what both Kevin and Jason said and add. I think it's interesting. Or maybe I don't even think it's interesting. It's interesting. I've had some emails recently about companies looking for help obtaining their Ginny ticket, and the pros and the cons. And Rob, would you help us? Or could you tell me a company that will help? So I think that Kevin and Jason have the advantage of already being Ginny issuers going into this and are reaping the benefits, as are a lot of TMC members. And now you have companies who may not have their Ginny ticket who are listening in on this call, and just maybe some that probably aren't, who are playing catch up a little bit. So I think we'll see, or I think Ginny Mae will see an uptick in issuers this summer, or I should say interested parties. And I think that any servicing experts that are on the call who have serviced Ginny Mae loans, I think their value in the job market is going up every week based on what I'm seeing. So it'll be kind of fun to watch if the Ginny Mae issuers pick up, because as you know, Rich, Ginny Mae likes issuers when they actually issue Ginny Mae's, when they're actually active in the market. They just don't want companies becoming approved by Ginny Mae, then wanting something to tack on their wall like a diploma and never using it because those tend to get booted. So I think it'll be interesting for the remainder of the year to see what happens with the number of issuers and how active they are. And what happens. So
Great
on we
stuff.
go.
Yeah, that's
Onward and
certainly,
upward.
that's something we've heard from our members as well. A lot of interest just around, the process of getting approved with Ginny. And I think that, is a trend you could see. So, well, good stuff, fellas. I think we've decided we want to make this a recurring call every 3 or 4 weeks officially. That's what we've been doing anyway. And always one of our most well attended. We had over 100 of our lender members on the line, and a lot of great insight, a lot of great information as always from this trio. Jason, Kevin, Rob, thank you very much for your time this afternoon.
I was hoping we get another look at Kevin's vehicle, the interior.
Yeah, right.
Plain
That's
Corinthian leather. I think isn't that veal leather in there, Kevin?
There you go. You get.
I know what that is. That's
Here
one
we
of
are.
those Teslas. That's one of those Tesla SUVs.
It is. It is. And you know what? I moved to California 4 years ago. What's funny is this is my truck next to it. That's my old H2. Okay.
Here in Nevada.
So I had the H2 gas guzzler parked in the driveway right next to my Model X. So people are like, this guy's totally bipolar. And there's some
Another requirement of the mortgage industry, bipolar.
So you have to be crazy to do this stuff. But my car drives itself. You guys remember my last call? I was just talking away, yapping away, and the car's driving down the highway. So, we really do grasp technology over here on my thing. So trying to keep it real.
Good stuff. Well, we have another call coming up in about 6 minutes on training remote employees remote. It's been a top topic for our members. So that is coming up in 7 minutes. And thanks again to our discussion leaders and everybody that was on the line. Have a great afternoon, everyone. Take care.
Thank you, guys.
Thank you. Thank you, Rob. Thank you for bringing the word autumn back. It's not used enough. I love it. I love it.
All right. Bye, guys.